Hello, everyone, and welcome back to the Deep Dive. We are navigating the complex and often counterintuitive world of institutional finance today, and we're going right to the heart of competitive scale and durable dominance.
It's a field really defined by just a handful of undisputed titans, and today we are setting our sights on, well, the biggest one in the room, the Charles Schwab Corporation, ticker
Yeah.
SCHW.
Schwab looks on paper like the ultimate scale winner. I mean, the definitive consolidator of the entire digital investing space. They handle over $11 trillion in client assets, a number that's almost, too large to even comprehend.
It makes them one of the largest financial firms on the planet.
Exactly. But here's the central question we have to answer. Is the structural quality of this massive financial aggregator as robust as its sheer size suggests? We know size matters, but it also creates complexity. Specifically, is its very high reliance on net interest revenue, or NIR, a hidden vulnerability? Is it just waiting for the next sharp pivot in interest rates to expose it? We're going to stress test the entire competitive fortress.
And separate that cyclical noise from the real structural quality. That's the mission. We have to look past the quarterly reports and get right into the engine room to see what truly drives sustainable value here.
And before we get into the very dense financial architecture of Schwab, just a quick note for everyone watching.
Right. Navigating a deep dive like this, it really helps to have the right tools and platform if you want to act on your ideas.
Absolutely. For those who want to execute on these investing ideas with, real precision, having a professional grade platform is key. We use Interactive Brokers because of their superior execution speed and global reach, and we've actually partnered with them to get you, the viewer, a stock bonus when you sign up.
So you get a bonus to help kickstart your portfolio, and you support the channel and its mission to deliver this kind of, rigorous analysis. That link is in the description right below.
That's right. And of course, if you find value in this kind of deep discussion, if it helps you synthesize knowledge quickly, the best way to let us know is to subscribe and hit that like button. It truly helps the channel. And if you have questions about Schwab's float or the competition, please let us know in the comments.
Excellent. Okay, let's leave the logistics there and get right into the foundational analysis. We have to start by defining the core engine before we can even begin to stress test its risks. So let's make our first pillar of discussion, the business model and competitive fortress.
Okay, let's unpack that core engine. We hear Schwab called a financial supermarket all the time. It sounds good, but when you break down the mechanics, what does that hybrid model actually entail? I mean, how does it generate revenue? Is it still a brokerage at its core, or is it something else now?
It's fundamentally a hybrid, and that's precisely why that supermarket analogy works so well. They are not just the discount brokerage of the 90s. That model, attracting customers with cheap trades, it served its purpose, but it's largely irrelevant for revenue today.
So what are they now?
Today, Schwab is this complex blend. It's a discount brokerage, pulling in self-directed traders, sure. But it's also a full-service wealth management firm for high-net-worth individuals, and critically, for registered investment advisors, or RIAs. And on top of all that, they operate a regulated banking entity, Schwab Bank.
And those three pieces translate into three different but very integrated revenue engines. What are they, and what's the pecking order, especially in today's interest rate environment?
They are net interest revenue, which we call NIR, then asset management and administration fees, and finally trading revenue. And the hierarchy is crystal clear. NIR is first, often by a huge margin, then the asset management fees, and way down at the bottom is trading.
Okay, so that dominance of NIR in a high-rate world, that's the source of all the market's anxiety and really the key to their whole economic model.
It is.
So let's really hone in on that dominant force, net interest revenue. For anyone learning about this, we need to be really precise about the mechanism because this cash sweep is probably the most misunderstood part of Schwab's business.
The mechanism is, it's elegant in its simplicity. It's the scale that makes it so powerful. When you, as a client, deposit cash into your Schwab brokerage account, that cash is automatically swept into Schwab Bank.
Which is a fully regulated bank.
A fully regulated bank, yes.
Yeah.
So that cash is categorized as a very low cost or even zero cost deposit from the client's perspective. The bank then takes that capital, this giant pool of client deposits, and invests it. They do it conservatively, mostly in low-risk, high-quality bonds like U.S. Treasuries, agency mortgage-backed securities, that sort of thing.
So Schwab Bank is basically using the client's idle cash as its own internal, ultra-low-cost funding source.
Exactly. The difference between the interest the bank earns on those investments and the, often negligible interest it pays back to the client on that sweep balance.
Yeah.
That is the spread. That spread is the net interest revenue.
And when the Fed hikes rates,
The returns Schwab earns on its side just surge. And because the rate they pay, the client lags, I mean, it barely moves, that spread expands massively. And suddenly NIR just explodes and completely dominates the income statement.
so the zero commission trading, that was the brilliant sacrifice. It was the free ticket to get onto the platform. But the cash sweep is where the real value is actually harvested. It's a system that monetizes doing nothing.
Right.
Asset inactivity, not trading activity.
Precisely. It incentivizes you to consolidate your whole financial life. Your idle cash, emergency fund, 401k, cash all with Schwab. The other two engines, they're smaller, but they're crucial for stability. Asset management and admin fees are driven directly by the sheer volume of client assets.
The AUM.
The AUM, right. So this includes fees from advisory services, managed portfolios, Schwab's own ETFs. This revenue is super recurring, very high quality. It grows organically as clients add money and as the market itself appreciates. It's a critical anchor when rates fall and NIR shrinks.
And trading revenue is now just a niche play.
Correct. With U.S. stock commissions at zero, the trading revenue that's left comes from higher margin stuff like options, futures, foreign exchange. It's important for keeping the really active traders on the platform, but it's a tiny piece of the overall profit picture.
Looking at the macro picture, this whole model seems perfectly positioned for the long term. They're a massive beneficiary of this structural shift toward low-cost digital investing.
It's an enduring model because it taps into fundamental human behavior. Investors want convenience, low cost, and maybe most of all, trust. By putting everything investing banking advice onto one trusted platform, Schwab creates immense stickiness.
Which brings us directly to the source of their durability, the economic moat. If everyone offers zero commissions now, what's stopping a flood of competitors? How do they defend this fortress?
Well, the moat isn't one thing. It's a whole defensive system working together. It's built on massive scale, of course, but also high intangible assets, that 50-year brand of trust. And then the killer, the high switching costs involved in leaving an institution that holds your entire financial life. That's the friction.
And the best recent example of this friction has to be the TD Ameritrade integration.
Oh, it's the definitive proof of the moat in action. That successful transition, as complex as it was, showed the immense quantifiable friction involved. It wasn't just about moving a few retail accounts.
No.
It was transitioning millions of clients, including tens of thousands of those RIAs who manage billions for their own clients. For an RIA, moving their whole book of business means porting historical data, learning new compliance systems, moving client banking, 401ks, and then dealing with platform differences, even after Schwab smartly kept the Thinkorswim platform.
That level of disruption.
Yeah.
It costs RIAs and individual clients thousands of dollars, hundreds of hours, compliance headaches.
Yeah.
It's the ultimate high-friction event. You just don't do it unless you have to.
Absolutely. This friction is like a tangible exit fee. It actively stops competitors from poaching high-value clients and lets Schwab maintain strong profitability, even on services that look free on the surface.
And the moat, unlike what you see in a lot of mature businesses, actually seems to be getting wider because of the scale they got from Ameritrade.
It is widening significantly. That acquisition wasn't just about getting more assets. It was about achieving an operational scale that very few institutions on Earth can challenge. That scale lets them constantly lower the average cost to serve each account. That's a true scale cost advantage.
Which they can then plow back into the business.
Right. They can invest billions a year in tech, in security, in research, an investment level that creates an almost insurmountable barrier for smaller fintech challengers. They just can't sustain those kinds of losses long enough to compete on cost and features.
This structure seems tailor-made for certain investment mental models, particularly the ones that Charlie Munger always talked about. Let's connect this back to his ideas of the toll bridge and the float.
Schwab is perhaps the purest modern example of these models in finance. They absolutely operate the toll bridge. They offer zero commission trading, that's the minimal toll, to get you, the customer, onto the platform, which is the bridge. Once you and your assets are on that bridge, you're functionally captive because of the switching costs we just talked about.
And once that captivity is established, the massive float mechanism kicks in and generates those superior returns.
Precisely. That huge, sticky pool of client cash acts as low-cost recurring capital. That's the float. It is effectively an interest-free or near interest-free loan from the client to Schwab. Unlike a traditional bank that has to pay competitive rates for deposits, Schwab uses client cash as its primary ultra-low-cost funding source.
That just fundamentally lowers their overall cost of funds compared to almost any competitor, right?
It's a hugely potent structural advantage that just compounds year after year.
So the competitive edge isn't just being the biggest, it's using that size to access a funding source, that low-cost client cash that completely reshapes their entire economic structure.
It's a structural funding advantage that translates directly into better margins and higher profitability. And that is why understanding the risks to that NIR stream is so critical.
To put all this durability into context, we need to spend some time on the competitive landscape. Who is actually trying to breach this fortress, and where are Schwab's weaknesses compared to these rivals?
It's a mature oligopoly. It's dominated by players with decades of history. And Schwab's unique combination of services is what keeps them on top. But their rivals are, they're formidable.
Let's start with the big one, the rival everyone points to, Fidelity.
Fidelity is a true force. They're exceptionally strong in the direct-to-consumer space, especially in retirement plans, 401ks, IRAs. They often dominate institutional retirement services. Their key competitive advantage, they're privately owned.
Which gives them immense flexibility.
Immense. They can take a truly long-term view without the pressure of quarterly public reporting. They can afford to invest billions in tech or take lower margins to gain market share without worrying about Wall Street punishing their stock. However, Schwab, especially after the Ameritrade deal, has the clear edge in the crucial RIA custody market, the B2B side, which is often stickier and higher value than your average retail account.
Okay, then you have the platforms that are built for speed and cost, like Interactive Brokers.
Right. IBKR is the gold standard for the professional active trader. Their advantage is twofold. Superior execution speed. They often get you a better price on your trades and industry-leading low-margin loan rates. They also offer access to dozens of global markets, which is far beyond Schwab's immediate reach.
But there's a trade-off.
A big one. IBKR is fundamentally an execution platform. They deliberately avoid Schwab's comprehensive, high-touch wealth management. They don't have the expense of a physical branch network. They're excellent for a specific type of user, but they don't serve that full supermarket spectrum.
And finally, Vanguard, which operates on a completely different philosophy.
Vanguard is the pure-play, low-cost, passive index leader. Their competitive advantage is structural purity. Their funds are set up to minimize costs, and that puts constant downward pressure on pricing across the entire industry. However, Vanguard lacks the sophisticated brokerage tools like Thinkorswim, the deep options trading, and the robust advisory network that Schwab uses to serve everyone from high-net-worth clients to active day traders.
So Vanguard's model is about pressuring AUM fees, whereas Schwab's is about monetizing that float.
Exactly.
So if we synthesize all of this, Schwab's durable edge really remains that unmatched, holistic model.
It is the holistic package. They combine the B2B moat of RIA custody, the full-service retail presence for trust and advice, zero-commission brokerage for mass adoption, and the powerful trading platforms. This just makes them the default home for client assets at almost every stage of an investor's life. And their competitors individually just can't fully replicate that.
That gives us a tremendously powerful picture of the business. We have to now turn to the second critical piece of the fortress: management stewardship and financial resilience.
When you're analyzing a company at Schwab's scale, management's job isn't micromanaging. It's about setting the long-term culture, managing risk, and critically allocating capital effectively over decades.
Let's start with the leadership philosophy. CEO Walt Bettinger has been at the helm for, nearly 17 years now? Let's talk about that philosophical backbone, that 50-year view preached by the founder.
Bettinger's long tenure provides huge cultural stability, but the philosophy is the bedrock. He and the whole organization are guided by this principle of thinking on a 50-year horizon, and that means they're willing to accept pain today, specifically revenue hits, to ensure the competitive position of the firm 50 years from now.
50 years is an eternity in finance, which is so often dominated by the next quarterly earnings call. And that focus drives their golden rule approach, right? Managing the business with the seriousness of holding other people's money.
Exactly. It's the definition of an owner-oriented, long-term approach. They see themselves as temporary stewards of client assets, and that mandates a focus on absolute balance sheet integrity and trust above all else.
But I have to challenge that 50-year view. Just a little. While stability is good, doesn't that long-term focus sometimes breed a bit of, corporate slowness? Doesn't it make them late to adopt necessary tech shifts that smaller, hungrier fintechs can exploit? We saw this with their initial reaction to crypto, or even with lagging tech like instant cross-platform payments.
That is a crucial and a very fair challenge. It really highlights the inherent trade-off. Yes, Schwab is deliberately slow to adopt disruptive technologies that lack regulatory clarity or operational history, like full crypto custody. They prioritize safety, regulatory prudence, and trust over being first.
So they're not trying to be on the bleeding edge.
No, they understand their core clientele, especially those high-value RIAs, value the security and balance sheet integrity of Schwab far more than a fractional tech edge in some niche product.
So the deliberate slowness is a feature, not a bug, of that 50-year view. They sacrifice leading-edge tech adoption for maximum security.
Precisely. They have the scale and the capital to just acquire or replicate any truly successful technology once it matures.
Yes.
They will not risk the brand's most important asset, trust, by being a guinea pig in unproven areas.
That strategic focus leads directly to their track record of rational capital allocation. The company has made some moves that few public companies would tolerate, all in the name of that long-term perspective.
There are two monumental examples. The first was the decision back in 2019 to move to zero commission trading for U.S. stocks and ETFs.
That was an intentional gut punch to a huge, high-margin revenue stream.
A massive short-term revenue hit. But it was the perfectly rational long-term move. It solidified their low-cost brand, it put existential pressure on their competitors, and most importantly, it drove millions of new investors onto the platform.
All of whom brought cash balances with them.
All of whom brought sticky cash balances that feed that lucrative NIR float. They successfully traded high-margin transactional revenue for structural asset aggregation power.
And the second major strategic move,
The TD Ameritrade acquisition. That was a gargantuan consolidation. It instantly widened the moat, increased their already huge scale, eliminated a key rival, and crucially, gave them access to that highly valuable RIA client base and the thinkorswim technology. Integration has been complex and expensive, yes, but the long-term competitive insulation it provides is undeniable.
it was a clear choice, competitive positioning over easy quarterly profits. Now moving to shareholder returns, how do they handle returning capital?
They maintain a modest, stable dividend, which is appropriate for a financial institution. More critically, though, management has a history of very opportunistic share buybacks. The mention of buying back $2.7 billion in a single quarter, that speaks to their conviction when they think the stock is undervalued, typically during these periods of interest rate volatility.
So they're returning capital when it's most accretive. Okay, now we have to get into the nuance of the financial fortress itself, specifically the quality ratios. Let's talk consistency.
The quality of the business model is highly consistent, but the level of profitability is highly cyclical. It naturally surges when markets rise, boosting AUM fees, and when interest rates rise, which boosts that NIR spread. But the underlying quality metrics, they stay strong across all cycles.
Let's focus on the quantitative hallmark of quality, return on invested capital, ROIC.
Because of the leverage in the banking model, we often look at return on equity, or ROE, and Schwab's ROE often runs near or even above 20%. Given that they operate a low-capital brokerage on top of the bank, this strongly suggests that their ROIC consistently and significantly exceeds their cost of capital.
And that ratio ROIC sustainably exceeding cost of capital, that is the definitive mark of a business with a powerful economic moat. They are incredibly capital efficient.
Exactly. Most large traditional banks struggle to consistently hit 12% to 15% ROE. Schwab's structural difference allows them to operate on a superior economic plane. Plus, their free cash flow conversion is usually excellent. It's a digital brokerage, they don't need much capex, so net income turns into cash flow very efficiently, which is what funds those big buybacks.
However, we must address the primary source of market anxiety, the balance sheet nuance, and that highly scrutinized, held-to-maturity HTM securities portfolio. We need to get technical here.
This is critical. When the Fed hiked rates so rapidly starting in 2022, Schwab saw significant deposit migration. Clients were pulling cash out to get higher yields elsewhere. The bank had to rely on other capital and FHLB advances to fund this. The core issue, though, is in their bond portfolio, the part labeled HTM.
Explain what HTM means and the core risk here, this duration mismatch.
HTM means the bank bought bonds, high-quality treasuries, and agency MBS, with the legally stated intent and ability to hold them until they mature. Because of this, The day-to-day price fluctuations don't hit the income statement. However, they bought most of these when rates were near zero. When the Fed hiked rates so fast, the market value of those low-coupon bonds just plummeted, creating billions in unrealized losses in that HTM portfolio.
So the technical risk is duration mismatch.
Exactly. The duration of their assets, the bonds, was much longer than the likely duration of their liabilities, the client deposits. The bank was positioned for a world of permanently low rates. When rates surged, they were left with low-yielding assets locked up for years, while their funding costs of the pay for supplemental borrowing skyrocketed.
So the anxiety isn't about credit quality. These are safe bonds. It's about liquidity and the perception of their capital adequacy.
Precisely. If they were ever forced to sell those bonds to meet mass withdrawals, those unrealized losses would become realized, instantly hitting their regulatory capital. Now, management argues they have sufficient liquidity, but the mere existence of these massive unrealized losses creates a perception problem, and it restricts their flexibility. It's a temporary issue that will resolve as bonds mature or rates fall, but it requires continuous monitoring.
That comprehensive analysis sets the stage perfectly for the final section. We have the moat, the management, and the balance sheet risk. Now let's move into growth, risks, and second-level thinking.
When we approach Schwab's valuation, we have to realize that the market has historically valued it as a premium financial hybrid. But that premium, it has eroded significantly because of all this recent cyclical anxiety,
Why does it typically command a premium over traditional banks?
because of the high structural quality we've been talking about. The superior ROIC, the recurring asset management fees, and that vast defensible moat. This allowed Schwab to command a much higher valuation. But since late 2022, the valuation has become highly cyclical.
That cyclicality is driven by the market treating it like a pure rate-sensitive regional bank.
Yeah.
This creates opportunity, but only if an investor correctly defines the margin of safety.
Right. And the margin of safety for Schwab is achieved when the price reflects a lot of pessimism on three specific fronts. First, the price must discount a sustained period of low to zero interest rates. You should not pay a price that assumes today's high NIR profits are permanent. You have to build in a scenario where that spread compresses significantly. Second, the price needs to be driven down by a temporary, non-permanent setback. You're looking for weakness caused by a short-term integration problem, a minor regulatory fine, or just a market correction that temporarily slows down asset gathering.
And crucially, the entry price has to completely ignore the long-term organic growth engine.
Absolutely. If you can buy the company at a valuation that effectively assumes it just stops growing organically, then you have a margin of safety. This growth engine is that persistent compounding flow of core net new assets, or NNA.
Let's hone in on that. How does that 5-7% NNA target translate into compounding power over a decade?
NNA is the steady, organic inflow of client funds. It's money that just walks into Schwab's ecosystem year after year, regardless of what the market is doing. On an asset base of nearly $12 trillion, a consistent 5% organic growth rate that translates to almost $600 billion in new assets brought in every single year.
That's a staggering number.
And that money compounds massively. That inflow simultaneously increases total AUM, which boosts the recurring asset management fees. And most critically, every new dollar brought in has a cash component that feeds the low-cost float, perpetually increasing the size of that profitable NIR funding base. NNA is the perpetual tailwind, and it's compounded further by market appreciation on the existing base.
Okay, now for the fun part. The permanent impairment risks. What's the bear case that could truly break this fortress?
We have three major structural threats. The first, and by far the most critical, is regulatory or political risk to NIR. This attacks the core economic advantage.
And how would the structural change actually happen?
It would involve regulatory intervention, maybe by Congress, the CFPB, or banking regulators, that permanently limits Schwab Bank's ability to monetize client cash. For instance, a regulation could mandate that banks have to pay significantly higher yields on sweep balances, far more than they do now. Or they could limit how much client cash can even be swept into the bank. If the government forces that net interest spread to compress by artificially raising the cost of funds, the biggest profit engine is permanently crippled.
We touched on this earlier, the political look of a massive institution making billions on client cash while paying almost zero interest. That is a vulnerable position.
It is politically toxic. While we don't expect a Dodd-Frank-style overhaul, even just targeted tightening on deposit yield requirement, it would neutralize the float as a source of superior low-cost funding. It's a low-probability event, but it's very high impact. The second permanent risk is a breakdown of trust. Schwab's Moat relies so heavily on its brand, its reputation. A catastrophic, widespread security breach, a major systemic failure of the RIA custody platform, something that causes a mass exodus of high-value clients and RIAs that could permanently damage the moat.
And the third risk that's often cited is technological obsolescence.
Correct. The risk here is some truly disruptive financial technology, maybe a globally adopted decentralized finance platform or a sovereign digital currency, something that creates a new insurmountable switching cost that just bypasses Schwab's entire legacy infrastructure. It's a lower probability risk, I think, due to their ability to acquire things, but technology never sleeps.
Shifting to the optimistic side, what are the near-term catalysts that could unlock value independent of what the Fed does?
Two major factors should accelerate earnings. The first is the successful final integration completion of TD Ameritrade. As those final platform migrations happen, they can capture the rest of the run rate expense synergies. Operational complexity goes down, support costs drop, efficiency rises. That's a direct margin boost, no matter what the economy is doing. The second catalyst is related to that balance sheet scrutiny. Bank funding stabilization.
Which just means reducing their reliance on expensive external funding that they use during that deposit migration period.
Exactly. The ongoing reduction of expensive supplemental funding sources, like that $12.9 billion decrease in high-cost funding we saw, that directly expands the net interest margin and boosts earnings. This is a powerful, management-controlled factor that improves efficiency simply by optimizing their funding base.
Okay, let's wrap this section with second-level thinking. Cyclical versus structural. We need to articulate why our long-term view might be different from the immediate market consensus.
The market consensus is easy to define right now. It is laser-focused on short-term interest rate risk, bank balance sheet concerns, the HTM bonds, and integration costs. The prevailing narrative views Schwab as a cyclical, rate-sensitive bank proxy. They're focused on the temporary pain points.
The contrarian view, based on our deep dive, focuses on the permanent strengths.
We believe the market is catastrophically underestimating the permanent strength of the economic moat and that compounding engine. The market sees cyclical pressure. We see a financial toll bridge with an ever-widening moat. The short-term pain from rate movements is temporary. The structural compounding of over $11 trillion in client assets via NNA and the CEO's consistent 50-year view. Those are the permanent, durable drivers of value. To synthesize this entire analysis, we need a clear summary of the bull case, and then we need to invert that thesis.
Okay, starting with the bull case summary. What are the four primary reasons to own this stock, assuming you buy it at a rational price?
First, the widening moat of scale and switching costs. The Ameritrade deal cemented its massive scale advantage, ensuring that financial supermarket model is durable. Second, the powerful compounding engine. That long-term organic net new asset growth acts as a perpetual tailwind, expanding both AUM fees and that lucrative NIR float.
Third, the rational owner-operator mindset. You have a management team guided by a long-term, client-centric philosophy, and they've proven they're willing to make strategic sacrifices for competitive position.
And fourth, high capital efficiency. The business consistently generates high returns on invested capital. You can see it in its superior ROE. It's a wonderful company. However, we have to reinforce the truism. Price is what you pay, value is what you get. Even a wonderful company must be bought at a rational price, ideally during a downturn driven by exactly the kind of rate anxiety we see today.
Now let's turn the thesis on its head. Let's run the red team challenge and present the ultimate counterargument. What is the structural vulnerability that could lead to permanent impairment here?
The most compelling argument for why this investment could fail is the structural vulnerability in its profit structure. The real risk is this. The company is an over-leveraged bank masquerading as a fintech champion.
That's a very sharp articulation of the risk. Explain why that masquerade is so dangerous.
The danger is that the majority of profits come from that cyclical spread on client cash.
Purchase.
If a sustained period of low interest rates returns, which crushes the returns on their float, and this happens concurrently with a massive political or regulatory push to mandate higher interest payouts to clients, then the largest profit engine is permanently crippled. In that scenario, the massive scale Schwab built stops being an advantage and starts becoming an operational burden. It transforms the financial supermarket into a highly complex, low-margin, capital-intensive utility where size is actually a liability, not an engine for growth.
It effectively breaks the float mechanism, which is the cornerstone of their entire superior economic model.
It fundamentally breaks the structure. That is the ultimate risk you have to monitor.
That was a tremendous deep dive into the Charles Schwab Corporation. We've synthesized two core ideas. the immense, durable fortress built on the power of the float and the toll bridge model, and the single largest threat being regulatory or political intervention in that net interest revenue stream.
Thank you for joining us as we dissected this complex financial giant. We really hope this framework helps you separate that temporary cyclical noise from the permanent structural quality of this business.
Before we sign off, you raised a provocative question about that regulatory risk to the NIR.
Right, we identified that structural regulatory intervention in the float is the single greatest risk to the thesis. But here's the thought I want to leave you with, especially as you conduct your own research. Given the massive multi-billion-dollar profits that are derived from client cash profits that go entirely to the institution, is political pressure for higher sweep yields a true black swan event? Or is regulatory intervention actually an inevitable political shift in the long run? I'd encourage you to research historical precedents for similar interventions in other financial floats just to better understand the true long-term probability of that critical event.
A fascinating and crucial piece of research for every long-term investor. Thank you for that insight.
Always a pleasure.
And thank you for joining us for this deep dive. If this analysis gave you clarity and perspective, please subscribe and like the video. We'll see you next time as we continue to tear down the world's competitive fortresses and analyze their true engines of value.